Hi, everybody. Steve Olson here with the Peak Group. I have kind of a timely episode as I welcome you back to the Investors Corner podcast. There's definitely a shelf life on this one because, man, it feels like this thing is changing by the hour, and that's the war in Iran and what it actually means for your real estate portfolio, both residential and commercial. There's a lot of noise out there right now, and so let's cut through it. Let's talk about what's actually happening on the ground. I'm not an economist. I'm not some geopolitical expert. In the end, I'm just a guy who invests in real estate. But I think I can share a few things that are worth thinking about in this crazy time that we're all living in. So here's the setup you need to understand. Heading into early 26, the market was finally showing signs of life. We definitely felt that. Mortgage rates, they had dipped below 6% in the first time in 4 years. Inventory was climbing a bit. Buyers who had been sitting on the sidelines were starting to come back. All those signals were pointing to a real reset year. Then the conflict with Iran broke out in late February, and it disrupted everything. The reason's pretty direct. The war caused an immediate shock to global oil markets through disruptions in the Strait of Hormuz. Oil prices spiked, and that fed into inflation expectations. And when inflation expectations rise, bond yields rise and mortgage rates follow. The 30-year fixed rate was sitting at like 5.99 the day before the conflict started. 4.99. And within weeks, it climbed up to 6.45. It's been hovering around, bouncing around in that range. And that might not sound like a massive move, but on a $400,000 loan, it's a meaningful difference in monthly payment. And it came right at the start of spring buying season, which is historically the market's most active window. Existing home sales, those dropped to a 9-month low. Buyer confidence took a hit, and that breakout year that everyone was expecting got delayed. So here's what's important, and this is where I want to give you some real perspective if I could be so bold. The market didn't collapse. It bent, but it didn't break. Pending sales are running near their highest pace since the pandemic boom ended. And listing views on Zillow, they're up over 30% year over year. Inventory is climbing a little bit still. And interestingly enough, even homeowners who locked in sub 5% rates, the people everyone assumed would never sell, about 35% of current sellers are in that camp, and they're listing anyway. You're looking at one of them. My family is moving. Life happens, people move, right? You can't delay it forever. So what we're seeing is a market with genuine underlying demand that got hit with a confidence shock. And that's different from a market with broken fundamentals. Supply and demand still favor real estate in most of the markets we operate in. DFW, Birmingham, starting in Savannah and Nashville. These are Sunbelt growth markets. People are still coming. The jobs are still there. Rates in the mid-sixes are not the end of the world. They're actually not far from the historical average. What spooked people is they came back up after a period of hope that they were headed down, right? We never like to see them bounce back up like that. On the commercial and development side, I do want to be straight with you. That picture is a little more complicated. Construction costs were already under pressure coming into 2026. The war hit, it made things worse. Steel mill products are up over 20% year over year. Aluminum's up 40%. Diesel, which drives everything from material and transport and equipment, that's climbed sharply. And gas is above $4 a gallon nationally. The Associated General Contractors put out data showing that input costs were running at 12.6% annualized rate in the first 2 months of the year before the oil shock ever fully hit the supply chain. So what that means practically is for developers is that projects that penciled 6 months ago may need to be re-underwritten. In fact, I've got 2 I need to re-underwrite. We've already seen a spike in project abandonments, up 23% in a single month, according to Construct Connect. A lot of developers penciled their pro formas with one cost basis, and now they're staring at a different number. And when your construction budget moves up 10 to 15% and your financing costs go up at the same time, many projects just don't work anymore. It's not a reason to stop building. It's a reason to be thoughtful about what you build and where. Bread and butter workforce housing, the kind of product we focus on at Peak, actually performs well in this environment because demand for affordable rentals goes up when homeownership becomes less accessible. So where does that leave us? For residential investors, especially those looking at single-family rentals, duplexes and fourplexes, the fundamentals haven't changed. Rates are elevated but manageable, and if they come back down, you can refinance. If you find a deal that cash flows today, that's your signal. Don't wait for perfect conditions that may never come. For commercial and development investors, we're at a period where underwriting discipline matters more than ever. Cost escalation is real, rate volatility is real, but deals are still getting done by experienced operators who understand their markets and have the right banking relationships. That's a tough one. At Peak, we're still active. We're still finding deals across DFW, Birmingham, and got one under contract in Savannah and pretty soon here in Nashville. So the noise in the macro environment, that's real, but real estate has weathered wars before. Long-term investors who stay calm and strategic are the ones who build wealth. Thanks for listening. We'll catch you next on the next episode of the Investors Corner podcast.